While Western analysts celebrate the recent drop in gold prices, while financial media declares the dollar's strength restored, while investors panic over red candles on their screens, something far more significant is unfolding in Beijing. A single article, published in the most powerful journal in China, written by President Xi Jinping himself, contains 3 words that could reshape the entire global financial system. 3 words that major banks hoped you would never notice. 3 words that explain why China has been quietly moving gold for over a decade, and why they are about to reveal a number that will force every central bank on earth to recalculate everything. The checkmate move is not coming. Welcome to Global Finance Revealed. This is not entertainment. This is strategic intelligence for those who understand that the world of money is changing faster than most realize. If you have been in business long enough, if you remember when a handshake meant something, when agreements were built on trust and backed by something real, then you know the value of reliable information. We ask you to do something simple. Subscribe to this channel, not because we need the numbers, but because the information shared here may prove essential in the months ahead. Click that button. It takes 3 seconds, considered an investment in knowledge. And tell us, where are you watching this from? Which corner of the world are you calling home today? Drop your location in the comments. Let us know who is paying attention. Now, let us begin. On the morning of February 3rd, 2025, while most of the financial world focused on the dramatic decline in precious metals prices, a document appeared in Beijing that received almost no attention in Western media. It was not a speech at an economic forum. It was an article published in Qiushi, a name that translates to Seeking Truth, the official theoretical journal of the Chinese Communist Party. To understand the significance of this publication, one must first understand what Qiushi represents. This is not a newspaper. It is not a magazine that accepts outside submissions. Qiushi is the ideological voice of the Chinese leadership. When something appears in its pages, it carries the full weight of state policy. It is a directive disguised as theory. The article was authored by President Xi Jinping himself. The title spoke of economic security and national strength. But buried within the carefully constructed paragraphs were 3 specific phrases that sent quiet shockwaves through the offices of central bankers who understand what they were reading. Powerful currency construction, acceleration of Yuan internationalization, financial security linked directly to reserve strength. These were not abstract concepts. These were marching orders. Xi Jinping was telling the People's Bank of China, telling the State Administration of Foreign Exchange, telling every financial institution under Beijing's control that the time had come to challenge the dominance of the United States dollar, not through military confrontation, not through trade wars alone, but through something far more permanent. Currency power backed by hard assets. The timing of this publication was not accidental. Less than 24 hours earlier, gold and silver prices had been hammered down in New York trading. The mainstream financial press celebrated this as proof that precious metals were losing relevance. Analysts appeared on television declaring that the dollar remained supreme. Investors who had positioned themselves in gold watched their portfolios bleed red. But in Beijing, the response was not panic. It was preparation. Because Chinese leadership understood something that most Western observers missed. The price smash was not a sign of strength. It was a sign of desperation. When a system must aggressively suppress the price of the very asset that threatens its credibility, that system is vulnerable. And vulnerability creates opportunity. The Qiushi article did not mention gold directly. Chinese policy communications rarely do. But those who study the language of Chinese economic policy know how to read between the lines. When Xi Jinping speaks of reserve strength and powerful currency construction in the same document, when he explicitly links financial security to tangible backing, he is speaking about gold. He is speaking about the one asset that cannot be printed, cannot be inflated away, cannot be sanctioned or frozen by foreign powers. For years, Western economists have dismissed China's gold strategy as irrelevant. They point to official reserve figures published by the People as Bank of China and claim the numbers are too small to matter. They argue that China holds barely 2,000 tons, a fraction of what the United States claims to hold at Fort Knox. But those official numbers tell only part of the story. And increasingly, analysts who track physical gold flows rather than official statements have reached a very different conclusion. They have concluded that China has been accumulating gold on a scale never before seen in modern history, that the official numbers represent a fraction of actual holdings, that thousands of tons sit in accounts that never appear in public reports. And now, with the publication of this Qiushi article, the possibility has emerged that Beijing is preparing to reveal the truth, not gradually, not quietly, but in a single announcement that would force the entire world to recalculate the balance of monetary power. This is what some analysts have begun calling the financial military parade, a demonstration of economic strength so overwhelming that it requires no military display. Just numbers, just truth, just gold. The The question is no longer whether China has been hiding its true reserves. The question is when they will choose to reveal them, and what happens to the global financial system when they do. There's a number that appears every month in official Chinese financial reports. It is a number that most investors glance at and then ignore, a number so small, so unremarkable, that it seems barely worth mentioning. 27 tons, sometimes 30, occasionally 15. The People's Bank of China reports these modest additions to its gold reserves with bureaucratic precision, month after month, year after year. Small increments that suggest a cautious, almost timid approach to gold accumulation. But there's another set of numbers. Numbers that do not appear in official reserve statements, numbers that tell a completely different story. These numbers come from customs data, from refinery reports, from mining production statistics, from the vaults of Hong Kong where gold enters China through channels that leave paper trails, even when Beijing wishes they would not. And these numbers do not match, not even remotely. In 2023 alone, Switzerland exported over 1,000 tons of gold to China and Hong Kong. The Shanghai Gold Exchange reported withdrawals exceeding 4,000 tons that same year. Chinese domestic mines produced approximately 370 tons, yet the official reserve increase for the entire year was reported as just 225 tons. The mathematics do not work. The gold is going somewhere. It is being purchased by someone. It is sitting in vaults controlled by entities connected to the Chinese state. But it is not appearing in the official reserve count that the People's Bank of China shares with the International Monetary Fund. This is not an accident. This is strategy. To understand where the gold is actually going, one must understand the structure of China's financial system. In Western economies, there is generally a clear line between central bank reserves and private holdings. But in China, that line is deliberately blurred. The State Administration of Foreign Exchange operates what are known as off-balance sheet accounts. These are holdings that belong to the state, but do not appear in official reserve calculations. They exist in a gray zone, legally separate from the central bank, but functionally controlled by the same political authority. Then there are the commercial banks. In China, the largest banks are not truly private institutions. They are extensions of state policy. When the Bank of China or Industrial and Commercial Bank of China purchases gold, is that a private transaction or a state acquisition? The answer depends on who is asking and why. There are also the sovereign wealth funds, China Investment Corporation, Safe Investment Company. These entities manage trillions in assets. They operate globally. They make investments that appear commercial but serve strategic purposes. And they are not required to report precious metals holdings as part of official reserves. Finally, there is the military. China's People's Liberation Army maintains its own strategic reserves. These are classified. They do not appear in civilian financial reports. The quantities are unknown. But intelligence analysts who track military logistics have noted significant movements of precious metals to facilities controlled by military commands. All of this creates a system where gold can flow into China, can be purchased with state-directed capital, can sit in vaults controlled by state entities, and yet never appear in the official reserve number that the world sees. Independent analysts have attempted to calculate the real total. They start with reported reserves of approximately 2,000 tons. Then they add estimated safe holdings, perhaps 3,000 more tons. Then commercial bank holdings acquired on state direction, another 2,000. Then sovereign wealth fund positions, another 1,000. Then military strategic reserves, unknown but possibly another 1,000. The conservative estimate reaches 9,000 tons. The aggressive estimate exceeds 15,000 tons. If the conservative estimate is correct, China already holds more gold than the United States claims to possess. If the aggressive estimate is accurate, China holds more gold than any nation in recorded history. And they have accumulated it quietly, methodically, without fanfare, without triggering the kind of price spike that would have occurred if their true buying had been visible to markets. This is the pattern. This is the evidence. This is why the Qiushi article matters. Because if Beijing is preparing to reveal even a fraction of these hidden holdings, if they are ready to move gold from off-balance sheet accounts into official reserves, if they are about to show the world what they have actually been doing for the past 15 years, then the financial military parade is not a metaphor. It is about to become the most significant monetary event of the 21st century, and almost no one in the West is prepared for what comes next. There is a moment in every chess game when the board appears balanced. Both players have pieces in position. Both seem to have options. The casual observer sees competition, equilibrium, a contest that could go either way. But the master player sees something different. The master sees that one side has already lost. They simply have not realized it yet. This is the position of the United States dollar today. For over 70 years, the dollar has functioned as the world's reserve currency. Not because of American economic superiority alone, not because of the size of U.S. markets, but because of a system carefully constructed in the aftermath of World War II and reinforced through decades of strategic decisions. The Bretton Woods Agreement made the dollar the center of global finance. The petrodollar system ensured that oil, the most critical commodity on earth, could only be purchased with American currency. The SWIFT payment network made dollar transactions the default pathway for international trade. An American military power guaranteed that any nation attempting to exit the system would face consequences. This was not a free market outcome. This was architecture, a design control. But architecture can be dismantled. Design can be reverse engineered. And control can be challenged when the foundation begins to crack. The cracks have been forming for years. Nations sanctioned by the United States began seeking alternatives to dollar-based payments. Russia and China established bilateral trade settlements in their own currencies. India began purchasing oil from Iran using rupees. Saudi Arabia, the cornerstone of the petrodollar system, started accepting Yuan for oil sales. Each of these moves was small, incremental, easy to dismiss as isolated incidents that posed no real threat to dollar dominance. But they were not isolated. They were coordinated. They were preparation. And they all pointed toward a single vulnerability that China identified years ago, a vulnerability that no amount of military power can defend against. The dollar is backed by nothing except trust. Trust that the United States will manage its debt responsibly, trust that inflation will remain controlled, trust that the political system will remain stable, trust that the dollar will hold value tomorrow because it held value yesterday. But trust is fragile, and China has been quietly building the weapon that destroys it. Gold is not about trust. Gold is about proof. A currency backed by gold does not require belief in government promises. It does not depend on the credibility of central bankers. It does not fluctuate based on political stability or fiscal discipline. It simply is, tangible, measurable, verifiable. This is why the yuan has struggled to achieve true international status despite China's economic size. The world does not trust Beijing's capital controls, does not trust the opacity of Chinese financial institutions, does not trust that the yuan will be worth tomorrow what it is worth today. But if China reveals that the yuan is backed by 10,000 tons of gold, or 12,000, or 15,000, trust becomes irrelevant. The equation changes entirely. Central banks around the world hold reserves to protect their currencies and facilitate international trade. Currently, approximately 60% of global reserves are held in US dollars, 20% in euros. The remainder scattered across yen, pounds, and other currencies. But what happens when a major economy offers a currency backed by the largest gold reserve in history? What happens when that currency can be exchanged for physical metal on demand? What happens when holding yuan becomes not a political choice but a mathematical advantage? Reserve managers begin to recalculate. Sovereign wealth funds begin to rebalance. Trade agreements begin to shift, not overnight, not in a panic, but steadily, inevitably. This is the checkmate position. This is why the timing of the Qiushi article matters. This is why Beijing has waited until this precise moment, when U.S. debt exceeds $36 trillion, when deficit spending shows no sign of slowing, when confidence in Western financial management is already strained. China is not trying to destroy the dollar through confrontation. They are offering the world an alternative, a choice, a lifeboat. And they are doing it not with threats or demands, but with the one argument that transcends politics and ideology: mathematics. If the yuan is backed by more gold than any currency in modern history, if that gold can be verified and accessed, if China opens its vaults for international audit, then the financial military parade will not be a demonstration of strength. It will be a transfer of power. And it will happen not because China forced it, but because the world chose it. There are moments in economic history when the rules change, not gradually, not through slow evolution, but suddenly, decisively, in a way that divides time into before and after. The abandonment of the gold standard in 1971 was such a moment. The collapse of the Soviet Union in 1991 was another. The 2008 financial crisis reshaped assumptions about banking and risk. If China reveals the true scale of its gold reserves, if Beijing announces that the yuan will be backed by verifiable precious metal holdings, the world will experience another such moment. The immediate market response will be violent. Gold prices will not rise gradually. They will gap higher. Trading will likely be halted multiple times as exchanges struggle to manage the volatility. Silver will follow, platinum. All precious metals will reprice within hours, but the metal prices themselves will be the least significant consequence. Currency markets will convulse. The dollar-yuan exchange rate, they will fail. The market will seek a new equilibrium based on the new reality of reserve backing. Every currency pair that includes the dollar will be affected. Euro dollar, pound dollar, yen dollar. Traders will scramble to hedge positions that were considered stable just days before. Volatility indices will spike to levels not seen since 2008. And then the bond markets will react. U.S. Treasury bonds are considered the safest asset in the world. The safety is based on the assumption that the dollar will remain the dominant reserve currency. That assumption guarantees demand for American debt, regardless of fiscal policy. But if that assumption breaks, if foreign central banks begin shifting reserves away from dollars and into yuan or gold, then who will buy the next $1 trillion of Treasury issuance? Interest rates will rise, not because the Federal Reserve chooses to raise them, but because the market will demand higher yields to compensate for increased risk. The cost of servicing American debt will increase. Deficit spending will become more expensive. The fiscal situation will deteriorate faster. This creates a feedback loop. Higher rates increase deficits. Larger deficits reduce confidence. Reduced confidence accelerates the shift away from dollar reserves. The cycle reinforces itself. Any company with significant dollar-denominated debt will face refinancing challenges. Any firm holding large dollar cash reserves will watch those reserves lose purchasing power in real terms. Any business dependent on imports priced in dollars will see costs rise, but there will also be opportunities. Companies positioned in Asian supply chains will benefit from yuan-based trade settlement. Firms with operations in BRICS nations will find new financing options outside the dollar system. Businesses that have diversified their reserve holdings into precious metals or alternative currencies will preserve capital while competitors scramble. The entrepreneurs who will thrive in this environment are those who understand that currency is not neutral. It is not simply a medium of exchange. It is a strategic asset that must be managed with the same attention given to inventory, personnel, and market positioning. This means several concrete actions. First, diversification of cash reserves beyond single currency exposure. Not speculation, not trading. Simply a recognition that holding all capital in one currency carries risk that was previously invisible but is now undeniable. Second, understanding of bilateral trade mechanisms, learning how to invoice in multiple currencies, establishing banking relationships in yuan clearing jurisdictions, building the infrastructure to operate in a multipolar currency system before that system becomes mandatory. Third, reassessment of supply chain dependencies. Companies that rely entirely on dollar-based trade routes will face disruption. Those with flexibility to shift between currency zones will maintain continuity. Fourth, attention to commodity exposure. In a world where currency values are unstable, real assets become anchors. Businesses with physical inventory, equipment, and property will preserve value better than those holding only financial assets. None of this requires predicting exact timelines. No one knows precisely when China will make its announcement. No one can calculate the exact scale of hidden reserves. But the direction is clear. The pattern is established. The signal has been sent. The financial military parade is not a distant possibility. It is an approaching reality. And the difference between those who prepare and those who do not will be measured not in percentage points, but in survival. The checkmate move is already on the board. The only question remaining is whether you see it, or whether you are still staring at yesterday's game, wondering why the pieces no longer make sense.